Hi, my name is Weston Nelson. My FASB codification is 810-910. The topic of this codification is on consolidations with industry-specific information for the construction and contracting industries. I chose this topic because we have been learning a lot about consolidations in class, and I have quite a bit of experience working in the world of construction. Today, I am going to try to look at these standards from the perspective of partnerships or sole proprietorships as much as I possibly can. As we have learned in class, consolidations happen frequently in the world of business, and it is our job as accountants to know how to record them. It is tough to look at any topics in a way that only includes partnerships because most mergers include at least one bigger company. However, if a partnership or private company purchases a public company, it is called a reverse acquisition. However, for the sake of time and for the purpose of staying on task in this presentation, I am not going to go more into that right now. Looking specifically at the construction industry, construction companies are unique. In a research study done by Ernst & Young, researchers found the construction industry to be one of the most prone to mergers and acquisitions. This is mainly because most companies are looking to add more scale and stability. For construction companies, you are likely to either find large consolidations or small privately owned partnerships. According to an article from constructiontoday.com, industry experts expect to see 50% or more of privately held businesses in the construction industry to transition ownership within the next 10 years. With that being said, I would like to look at some of the key words or terms that are used in the chapters involving consolidations. So before we look at the work papers, I would just like to spend a couple of time focusing on these words. It is important to know that the parent company, or the purchasing company, sometimes referred to as P, is the one that is purchasing the subsidiary, sometimes referred to as S. If the parent company purchases only a small portion of the subsidiary, it will use the cost method to account for the consolidation in the work papers. However, most consolidations in the construction and contracting industry involve either full or majority ownership transformations. Under this method, the parent recognizes its share of the profits and losses of the subsidiary in the periods when these profits and losses are also reflected in the accounts of the subsidiary. Also, any profit or loss related to the purchase for the parent is reflected as such in the income statement. With that being said, I just want to look at an example that I have on Excel and to show you how we would look at a problem like this in Excel. So, with this particular problem, we are looking at the purchasing company, also known as Parent Pete's Construction, and the subsidiary company, Subsidiary Steve's Builders. So, taking a look at this, on this page we have some of the financial information and the computation and allocation of different schedule. First, let's just look at some of the accounts that are listed. These are all things that we would be given to start the problem with. So looking at this, we have current assets, we have investment in S, we have property, plant, and equipment, which in this case would be the company HQ, machines and tools. And then we have land, liabilities, common stock, retained earnings at the beginning of the year, dividends declared at the beginning of the year, sales, dividend income, cost of goods sold, and other expenses. And these are all common pieces of information that we would have leading into problems like this. And it gives us both these for the parent company and the subsidiary company. And then on the right hand here, I have the computation and allocation of difference schedule, where basically it gives us a lot of information that we are going to need to know for when we make journal entries and when we make eliminating entries to adjust the financial statements. Speaking of that, let's take a look at the financial statements now. The first one we're looking at here is the income statement. And here you see we've plugged a bunch of the information that we had from the financials in the last tab. And we have the information for the parent company here on the left, and then information for the subsidiary company in the next column over. And then after that we have the debits and credits for elimination entries, followed by the non-controlling interest tab or column. And then on the right we total up the numbers from all the other columns. So just looking at that, we have the income statement, and important to note is the net income here at the bottom, because that will be used on the next tab in the retained earnings statement. So now let's take a look at that. In the retained earnings statement, we have the net income from the income statement right here. And then we have the typical retained earnings statement where we have the retained earnings at the top. Here we have the retained earnings from purchasing Pete's company, and here we have the retained earnings from subsidiary Steve's. And then we also have the eliminating entry where we cancel that out, and I'll show you the entry on the last tab that we will see. And then looking also at the dividends declared, we have purchasing Pete's, and then we have subsidiary Steve's, and then we also have an eliminating entry to get rid of most of that. But as you can see, we also have a small portion that is owned by the non-controlling interest. Looking at the last sheet here of financial statements, we have the balance sheet. On the left side, like usual, you can see the accounts, and here in the purchasing Pete's and subsidiary Steve's column, these were found from the financial information on the first sheet that we looked at, and that goes down and we just total them up. And then as you can see, a lot of the elimination entries that we have come from the balance sheet, and then here at the bottom we have totals. So that's the typical kind of information you'll get in a problem like this, and I just worked through this, and you just kind of follow the information it gives you. Now to finish it out, we'll just take a look at the journal entries. This first entry is to adjust the investment account and to eliminate intercompany dividends. In this entry, you would debit the equity and subsidiary income account while crediting the investment in subsidiary company. And then to cancel that out, you would debit the investment in the subsidiary company, and you would credit the dividends declared in the subsidiary company. For the next entry, we would do that to eliminate the investment account and establish non-controlling interest in equity. And you see we debit common stock in the subsidiary, the beginning retained earnings in the subsidiary, the pre-purchase subsidiary's income, and the difference between implied and book value. And we would also credit the investment in the subsidiary company and the non-controlling interest in equity. The last entry that we would have to do would be to establish the transfer of land and to eliminate the temporary account. And this we would debit the land account, and we would credit the difference between the implied and the book value. So with that, I just want to say, if anyone has any questions, feel free to ask those. Otherwise, I'm just going to show my list of sources that I use for this presentation as well. And that problem that we went over was found in the textbook on pages 189 to 191 in an illustration 414, and then I modified it for my particular case here. So with that, once again, thank you, and then any questions are welcome.